Welcome back to Boss Economics World, the only show that calls out the economic absurdities of our time with the razor-sharp wit you deserve. I'm your host, the no-nonsense, number-crunching, truth-dropping econ warrior, here to expose the dumpster fire of mismanagement, missteps, and outright madness in today's financial landscape. Buckle up, folks, whether you're a regular Joe worried about your shrinking paycheck or a Wall Street suit sweating over your portfolio, today's episode is going to hit you like a freight train of fiscal reality. Now, let's dive into the latest economic circus act, courtesy of the Federal Reserve and their ringleader in San Francisco, Mary Daly. On April 18, 2025, Daly dropped a bombshell, or should I say, a glitter bomb of vague promises, during an event at UC Berkeley. Her big reveal. The Fed might hold interest rates tighter for longer because, surprise, surprise, inflation risks are more elevated than they were a year ago. But don't worry, she says, they could still cut rates later this year. Oh, and there's no rush, because apparently, the economy is just a Netflix series we can pause and binge watch later. Folks, grab your popcorn, because this is economic policymaking at its most infuriatingly indecisive. But here at Boss Economics World, we don't just report the news, we dissect it, layer by layer, to reveal the hot mess underneath. So, let's break this down, from the surface-level clownery to the deep-rooted economic rot, and expose how the Fed, the government, and their merry band of enablers are driving us straight into a recessionary ditch. And trust me, I've got the data, the examples, and the receipts to back it up. Let's start with the headline act, Mary Daly's tightrope walk of contradictions. On one hand, she's warning us that inflation risks are rising, so the Fed might need to keep interest rates high, higher than they anticipated just a year ago. On the other hand, she's dangling the carrot of 2 quarter-point rate cuts later in 2025, as forecasted in the Fed's March 2025 summary of economic projections. Oh, and don't worry, she says, there's no need to rush. Really, Mary? No rush? Tell that to the millions of Americans drowning in credit card debt, facing record-high mortgage rates, and watching their grocery bills balloon faster than a TikTok influencer's follower count. Here's the kicker, Daly estimates the neutral interest rate, adjusted for inflation, at about 1%. For the uninitiated, the neutral rate is the Goldilocks level where monetary policy is neither stimulative nor restrictive. But here's the problem, the Fed's current policy rate, as of April 2025, is hovering around 4.5% to 4.75%, according to the latest Fed statements. That's way above neutral, meaning the Fed is slamming the brakes on the economy harder than a teenager learning to drive stick. And yet, Daly's out here saying, we have plenty of time to wait this out. Wait this out. Lady, the economy isn't a sourdough starter, you can't just leave it on the counter and hope it rises on its own. Now, let's peel back the layers to the real meat of this story. Why is inflation still haunting us in 2025, and why is the Fed so paralyzed by indecision? Spoiler alert, it's a toxic cocktail of government mismanagement, corporate greed, and the Fed's own spinelessness. First, let's talk inflation. Daly and Fed Chair Jerome Powell are sweating bullets over sticky inflation, and they're pointing fingers at President Donald Trump's latest trade policies. Trump, in his infinite wisdom, has decided to slap aggressive tariffs on imported goods, with plans to raise the average tariff rate from around 2% to a jaw-dropping 10% or more, according to the Peterson Institute for International Economics. Economists are screaming from the rooftops that this will lower growth and boost inflation in the near term. Why? Because tariffs jack up the cost of imports, which companies then pass on to consumers. Just look at the data. The PIE estimates that Trump's tariff hikes could add 1.1 percentage points to U.S. inflation in 2025 alone. And guess what? That's not even counting the ripple effects on supply chains, which are still recovering from the COVID-19 chaos of 2020 to 2022. But here's where it gets juicy, Daly seems bizarrely chill about all this. She's out here saying, we're in a solid place, and claiming that the firms she's talked to aren't laying people off or hunkering down. Oh, really? Let's check the tape. According to the Bureau of Labor Statistics, initial jobless claims spiked by 15% in March 2025 compared to the previous year, signaling early cracks in the labor market. And the National Federation of Independent Business reported in its latest Small Business Optimism Index that 62% of small businesses are delaying investments due to rising costs and uncertainty over trade policies. So, Mary, maybe the firms you talk to are sipping champagne in Silicon Valley, but the rest of America is bracing for impact. Now, let's zoom out to the big picture, because this isn't just about tariffs or inflation, it's about a systemic failure of leadership. The Fed's indecision is just the tip of the iceberg. The real culprits? A government that's addicted to reckless spending and a central bank that's too cowardly to call it out. Let's talk fiscal policy first. Since 2020, the US government has been on a spending spree that would make a reality TV star blush. According to the Congressional Budget Office, the federal deficit hit $1.8 trillion in fiscal year 2024, and it's projected to balloon to $2.1 trillion in 2025. Why? Because lawmakers can't stop throwing money at pet projects, tax cuts, and stimulus checks, all while refusing to raise taxes or cut spending in any meaningful way. And guess what happens when you flood the economy with borrowed cash? Inflation. The latest consumer price index data from the BLS shows that inflation is running at 4.2% year-over-year as of March 2025, well above the Fed's 2% target. Coincidence? I think not. But here's the real scandal: the Fed is complicit in this mess. Instead of slamming on the brakes years ago, they kept interest rates near zero for far too long, fueling asset bubbles in everything from stocks to real estate. Remember the housing market insanity of 2021 to 2023? According to the S&P CoreLogic Case-Shiller Home Price Index, home prices soared by 45% in that period, pricing out millions of first-time buyers. And now, with mortgage rates at 7.5%, those same buyers are stuck renting, while landlords jack up rents by 8% year-over-year. The Fed's belated rate hikes are like trying to sober up after a 3-day bender: too little, too late, and now the whole economy is hungover. So, where does this leave us? Spoiler alert, it's not a happy place. The Fed's tightrope act, keeping rates high to fight inflation while promising cuts to avoid a recession, is a recipe for disaster. Just look at the data. The Conference Board's leading economic index has been declining for 6 consecutive months as of April 2025, signaling a high risk of recession within the next year. And the yield curve? Inverted since mid-2024, according to the Federal Reserve Bank of St. Louis. For those of you keeping score at home, an inverted yield curve has predicted every U.S. recession since 1955. Cozy, right? And let's not forget the consumer, the backbone of the U.S. economy. According to the Federal Reserve Bank of New York, household debt hit a record $17.8 trillion in Q1 2025, with credit card balances alone surging by 12% year-over-year. Meanwhile, real wages, adjusted for inflation, have declined by 1.5% since January 2024, per the BLS. Translation: Americans are borrowing more, earning less, and getting squeezed by rising prices. Sounds like a recessionary powder keg to me. Folks, here's the bottom line: the Fed's waffling, the government's profligacy, and Trump's tariff tantrum are a three-headed monster dragging us into an economic abyss. Mary Daly can sugarcoat it all she wants, but the data doesn't lie. We're staring down the barrel of a recession, and the so-called experts are too busy navel-gazing to do anything about it. So, what's the fix? First, the Fed needs to grow a spine and stick to a clear, consistent policy, either commit to fighting inflation or admit they're okay with stagflation. Second, Congress needs to get its fiscal house in order, because borrowing $2 trillion a year to fund tax cuts and pork barrel projects is a one-way ticket to disaster. And third, Trump needs to ditch the tariff tantrum and realize that protectionism isn't a magic wand, it's a sledgehammer to the economy's kneecaps. But hey, what do I know? I'm just a humble econ warrior, armed with data, sarcasm, and a burning desire to call out the clownery. So, sound off in the comments: do you think the Fed's asleep at the wheel, or is this all just a soft landing fairy tale? And don't forget to smash that like button, subscribe, and ring the bell, because here at Boss Economics World, we're not just breaking down the economy, we're breaking the internet, one truth bomb at a time.